Welcome to Charged Alpha. I'm Hudson, joined by Lana. Today's chapter, Zebra Technologies, the enterprise technology company that just surged nearly 20% on a beat and a guide raise.
Zebra was founded in 1969 in New Jersey, rebranded and went public in 1991, and built the dominant platform for enterprise barcode and printing systems over 3 decades.
The turning point came in 2014 when Zebra acquired Motorola Solutions' enterprise division for $3.45 billion, adding mobile computers and handheld scanners to its product portfolio.
CEO Bill Burns took over in 2019 and shifted toward intelligent enterprise, integrating machine vision, AI-driven analytics, and software into Zebra's hardware platform across warehousing and healthcare.
Most recently, revenue was $1.495 billion, up 14% year over year, beating the $1.48 billion estimate. Non-GAAP EPS of 4.75 cents beat the 4.33 estimate by nearly 10%.
The company raised its full-year revenue guidance to 10 to 14% growth, a meaningful raise that drove analyst upgrades and price target increases across the covering banks.
The moat is the installed base. Hospitals, warehouses, and retailers that build Zebra devices into their operations become decade-long customers, locked in through workflow integration and service subscriptions.
Machine vision is Zebra's highest growth segment. Automated visual inspection, barcode reading, and spatial intelligence are replacing manual scanning, expanding Zebra's addressable market.
Healthcare is a key vertical. Zebra's medication verification, patient tracking, and clinical mobility devices embed deeply into hospital workflows, creating strong switching costs across hundreds of health systems.
The enterprise AI cycle is a structural tailwind. Warehouses deploying automation require Zebra's sensing and data capture layer, making it infrastructure, not just hardware.
Against Honeywell and Cognex, Zebra dominates enterprise mobile computing. Cognex leads in factory machine vision, but lacks breadth. Honeywell competes across both, but without Zebra's vertical depth.
Software and services revenue is the margin expansion lever. As Zebra layers analytics, device management, and workflow software onto its hardware base, recurring revenue and margins both expand.
The 2014 Motorola deal created leverage and integration complexity. Burns resolved it by divesting non-core assets, reducing debt, and refocusing on Zebra's highest return verticals.
Bill Burns came from Shire Pharmaceuticals and Honeywell before taking the Zebra CEO role in 2019. His background in mission-critical environments shaped Zebra's focus on healthcare and warehousing.
Burns has been disciplined on capital allocation, directing R&D toward machine vision and AI while returning excess cash through share buybacks.
The primary risk is enterprise CapEx cyclicality. When customers delay warehouse and retail technology investment, Zebra's hardware refresh cycle softens, as it did in 2023.
The 10 to 14% guide raise signals management's confidence that the refresh cycle has resumed at scale, with new machine vision workloads adding demand on top of replacement cycles.
Zebra Technologies just posted a 14% revenue surge and a 19.5% single-day stock gain on a beat and raised guide.
Let's get into the machine vision thesis and what the raised guide actually signals.
Enterprise mobile computing, machine vision, supply chain AI, Zebra is the sensing layer that powers the intelligent warehouse and hospital. Now let's get into the numbers.
2 years of inventory digestion, 2 years of enterprise customers refusing to refresh hardware. And then this quarter, Zebra Technologies prints $1.495 billion, up 14.3%, and the stock rockets 19% in a day.
The inflection finally arrived. Welcome to Charged Alpha. I am Lana here with Hudson, and today we are unpacking Zebra's Q1 2026, the quarter the demand pause officially ended.
Quick orientation before the numbers. Zebra Technologies, ticker ZBRA, is headquartered in Lincolnshire, Illinois, founded back in 1969, and employs roughly 10,700 people globally.
They make the barcode scanners, mobile computers, label printers, and machine vision cameras that run inside warehouses, hospitals, retail stores, and factories. If a worker is scanning something on a frontline floor, there is a decent chance Zebra hardware is in their hand.
The business now reports in 2 segments: Connected Frontline, which is the old EVM unit covering mobile computers and scanners, and Asset Visibility and Automation, formerly AIT, covering printers, RFID, and machine vision. That rebrand signals the strategic direction. ZBRA is moving from identification hardware into full-stack operational intelligence.
Now, the numbers, because this is where the inflection shows up. Revenue came in at $1.495 billion, up 14.3% year over year, beating consensus of $1.48 billion by roughly 1%.
Non-GAAP adjusted EPS landed at $4.75 against a $4.33 estimate. That is a 42-cent beat and almost 10% above consensus. Clean, with no one-time accounting noise propping it up.
Adjusted EBITDA hit $347 million, translating to a 23.2% EBITDA margin. Gross margin expanded to 49.6%, which tells you pricing discipline held even as volumes accelerated.
The segment split is where the recovery is most visible. Connected Frontline did $825 million, up 20.6% year over year. That is the segment most exposed to enterprise refresh cycles, and a 20+% print is the unmistakable signature of pent-up demand releasing.
Asset Visibility and Automation did $670 million, up 4.8%, slower, but with machine vision growing double digits inside it. Industrial automation cameras and sensors are the higher-margin, secular growth engine quietly building underneath the legacy printing business.
Free cash flow was $163 million in the quarter, and management raised full-year FCF guidance to greater than $900 million. That cash conversion is what makes the recovery investable, rather than just optically impressive.
On guidance, the full-year raise was meaningful. Revenue growth target moved to plus 10 to 14%. Non-GAAP EPS guidance moved to $18.30 to $18.70, with a midpoint of $18.50 versus prior street consensus of $18.09. A guide up this early in the year signals back-half order book visibility, not just a strong quarter.
Bill Burns runs the company as CEO, and his messaging on the call was straightforward. The inventory digestion cycle has ended. Large enterprise orders have resumed in manufacturing and logistics, and the pipeline is filling at the high end of historical norms. No equivocation, no hedging. That tone from management matters as much as the numbers.
Wall Street's reaction has been overwhelmingly constructive. The median analyst price target sits at $330, with the range stretching from $281 on the low end to $400 on the high end. Current rating distribution is 14 buys, 4 holds, and 1 sell.
Morgan Stanley remains at equal weight with a $323 target, which is the cautious end of the curve. Their thesis is that the inflection is real but already priced after the 19% earnings day move. They want to see a second consecutive beat before moving to overweight.
The more bullish desks argue the opposite, that this is quarter one of a multi-year reacceleration, not a one-print bounce. Full-year guidance was raised to plus 10 to 14% on revenue, and the EPS midpoint of $18.50 is meaningfully above the prior consensus of $18.09. The raise, this early in the fiscal year, typically signals management has visibility.
The primary bull thesis is the cycle turn. Enterprise refresh cycles in logistics and manufacturing run 3 to 5 years. If this is year one of the new CapEx wave, the beat and raise cadence has multiple quarters to run before comps get difficult.
The bear counterpoint is the valuation re-rate. After a 19% single-day move, a meaningful portion of the recovery multiple expansion is already in the stock. Bears argue that at these levels, you need a perfect execution environment, and macro surprises happen.
The bull case starts with the cycle thesis. 2 years of pandemic-era inventory finally cleared, enterprise refresh budgets are unlocking, and ZBRA is the entrenched incumbent capturing the rebound across logistics, healthcare, and retail. That is a structural demand catch-up, not a one-quarter anomaly.
Layer on machine vision. Double-digit growth, higher gross margin, and direct exposure to the industrial automation CapEx wave. That is the secular kicker on top of the cyclical recovery, and it is what justifies multiple expansion, not just earnings growth. Connected Frontline plus machine vision is a combination that compounds both revenue and margin simultaneously.
The bear case starts with the post-earnings chart. A 19% earnings day move on a 14% revenue print means a lot of the inflection is already in the stock. The risk-reward at $300+ is no longer asymmetric for new buyers.
There is also a tariff and supply chain overhang. A meaningful share of Zebra's hardware production touches Asia, and any new round of trade friction or component pricing pressure shows up directly in gross margin, compressing the 49.6% that the market is currently extrapolating forward.
And finally, the comp problem. Q1 was clean because the prior year was depressed. Once the easy comparisons roll off in the back half of fiscal 2026, the growth rate naturally decelerates, and the market will need to see machine vision pick up that baton to sustain the premium multiple.
On positioning, options implied volatility crushed back toward the low end of its 12-month range after the earnings print. That tells you the event-driven traders have exited and longer duration holders are settling in. The post-earnings calm in IV is a constructive signal for the stock's near-term stability.
Put-call ratio dropped to the mid-060s on earnings day as traders flooded into calls positioning for the sustained recovery. Open interest built at the 260 to 280 strikes for June expiration, suggesting institutional confidence that the rally holds through the next earnings cycle.
Insider activity has been quiet. No notable selling clusters in the weeks following the print, which is what you want to see after a stock moves 19% in a day. Short interest sits at low single-digit % of float, so this is not a squeeze story. The move was fundamental re-rating, which makes it more durable.
Looking forward, the catalysts are sequential and concrete. Q2 needs to confirm the order book strength. A second consecutive revenue acceleration would upgrade this from inflection to trend. Machine vision growth needs to hold at double digits to sustain the secular narrative alongside the cyclical recovery.
The FCF guide of greater than $900 million has to translate into either buybacks or strategic M&A that accelerates the machine vision roadmap. Management has the balance sheet flexibility to act. The question is whether they deploy it offensively or defensively.
The risks are equally clear. A macro slowdown that refreezes enterprise capital expenditure budgets, a tariff escalation that compresses hardware margins, or a stumble in the machine vision rollout that breaks the secular leg of the thesis. Any of those three would put the multiple under pressure.
That is the Q1 2026 read on Zebra Technologies. The 2-year inventory digestion wait is over, the guide is up, and Wall Street is repositioning higher. Inflection confirmed. If you want the next earnings breakdown the moment it drops, subscribe to Charged Alpha and turn on notifications.
Charged Alpha content is for educational and entertainment purposes only. Nothing you hear on this show should be taken as financial advice. We do not hold positions in the securities discussed unless explicitly stated. Always do your own research and consult a qualified financial advisor before making any investment decisions. This is Charged Alpha. We charge forward, so you stay informed.
Ooh, we do! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.